Good morning, ladies and gentlemen, and welcome to the UTILICO Emerging Markets Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Investment Manager Charles Gillings. Charles, good morning, sir.
Good morning, and thanks for the introduction. And welcome everybody to our fourth presentation. We were just commenting time flies, and it certainly has this year. I'm joined today by Jacqueline Brewer, who's a Deputy Portfolio Manager and looks after infrastructure assets, and John Grucock, Deputy Portfolio Manager and looks after utilities. Our format is the same, but we have, I hope, introduced some new slides and new context and new insights that will help investors in their journey of understanding UTILICO emerging markets. Slide one. Just to emphasize, we remain focused on operational infrastructure and utility assets. Over 95% of our portfolio are assets that are actually up and running and operationally leveraged and benefiting from long-term infrastructure megatrends. And I'll come on to that in more detail. Top right, we are predominantly focused on the emerging markets, and that will remain the case. Over 95% of our portfolio is focused on the emerging markets. Bottom left, we are bottom-up investors. This means we put a lot of emphasis on the individual asset, the management team, the jurisdiction, and the opportunity asset by asset. We're benchmark agnostic, and that remains the case. Today, we'll give you some details, but we are effectively uncorrelated to the benchmark. We maintain a long-term investment horizon. There are a number of elections coming up, which will give interesting outcomes in a number of jurisdictions. But I think our conversation internally, and especially as an investor, remains looking at the duration of the underlying assets and the underlying life cycle and the investment opportunity. Bottom right, performance has remained strong. Over 1 year, 3 year, 5 years, and since inception, we're ahead of the MSCI index. So while we don't track it, we know that investors do look at it as a reference. Next page. So UTILICO emerging markets remains unique. There is nobody else who's offering investors exposure to utilities and infrastructure assets within the emerging markets. And I'll come on to, if you want, why we think that's interesting. They are real assets. As I've said, they're operational. They're things like ports, airports, toll roads, power transmission, gas distribution. So they are physical operational assets, and they have with them a predictable and sustainable and growing income. Obviously, we have to find the right management team and the right regulatory framework, but in some ways, that's our unique opportunity, is to unlock that value. We're an experienced management team. There've been no changes over the 6 months, and pleasingly, having just been to Asia, it was really good to see us be able to benchmark and ground a lot of our discussions because of our knowledge of these assets in these markets. Strong performance, as I've noted. We've delivered a remarkable performance since inception. We have a lower volatility than most, and you would expect that with the types of assets we invest in, but pleasingly, our active share is very strong. and our performance, alpha, has been very strong over these 6 months, so a pleasing 6 months for us. Looking at the 6 months, NAV was up 6% over a 6-month period. That's a good outcome. I think that's just a highlight. Bottom left, our total compound return hit 9.4% through 30th of September, up from 9.3%, which is what you'd expect given the NAV performance. Revenue earnings per share, 5.95p. Dividends, we paid 2 quarterly dividends, and they were covered. So that's a strong outcome and a consistent outcome. In terms of, if you want, just what does this look like graphically, it's always pleasing to see that, if you want, the NAV performance of UAM continues to be strong, and we have outperformed the index most periods throughout UEM's existence, and that's a strong positive. Dividends, while we invest for total return, that's our focus, because the assets are operational, because they're generating a cash flow, a number of them pay a dividend. As we note here, over 80% of the portfolio currently pay a dividend. This enables us to pay a dividend to our shareholders, and the current yield at 4.1% is certainly well above anybody who's focused on total return, and is a strength, I think, for investors if they're making investments into Utilico emerging markets. Macro update, and let me just talk a little bit about the slide. In 2023, US growth has moderated, but it's been stronger than most anticipated. And I would note, I think across the markets, places like the Philippines, Indonesia, Vietnam have all delivered very resilient growth for 2023. China's reopening recovery was weaker than we anticipated. We certainly invested more into China in February, March, April, with a view that there would be a strong bounce, especially in areas like travel, as we experienced in the West. This has not been the case. China has, if you want, is taking time to recover from the impact of COVID, and certainly 2023 will go down as a disappointing year. I think the other thing to note in 2023 is tighter fiscal policy has begun to bite. We are seeing inflation rolling over in most markets. So what's the outlook for 2024? We think developed market growth will slow in the face of, if you want, strong interest rates from central banks. However, the labor market will remain tight, and therefore inflation may linger. And that's a feature that we will have to keep a close eye on. Weaker demand. We do think the global economies are collectively slowing, and that will be the case. And I think central banks will remain vigilant to inflation. Geopolitical tensions, they remain extremely elevated. The discussion around the Ukraine, the discussion around the Middle East, and the discussion around, if you want, the US-China and Taiwan, are certainly things that are needing to be brought into focus in terms of investment decisions and outlooks. That said and done, we do expect the emerging markets to grow and quicker than the developed markets, and therefore the gap to widen. We do expect the US dollar to weaken. We think the US has the ability to lower interest rates, and as and when they start, the dollar will weaken further, and that will drive value into the emerging markets. Key elections are clearly the US, Mexico, and India, and the outcomes of those will be varied depending on how you look at the various markets. We put in the top right real interest rates, and the objective here is just to highlight that most countries are seeing real interest rates, i.e. the difference between the central bank rate and underlying inflation at decade highs. And that gives us hope and confidence that over the next 12 months, we would expect that to narrow, and therefore central banks are certainly in a position to cut interest rates. If you looked at Brazil, they have high interest rates with inflation trending down, and therefore they can cut rates. Chile could cut rates. Most of Asia can cut rates, and therefore there is a tailwind going into 2024, which should be good for equities and should be good for emerging markets and should be good for our portfolio. Just touching on some topics that we've talked about before, inflation, just to highlight, a number of our investments do benefit from contracts which are linked to inflation, and certainly over the last 6 to 12 months, we've seen most of our companies able to increase their top line. It's been really pleasing to see where they've had the opportunity, they have taken it and implemented a disciplined approach. And that outcome is obviously good for our investments. Interest rates, while they're elevated, and that is a drag on some investments, I would just note that our debt to EBITDA ratio at 2 times is actually, I think 6 months ago when we did this was 2.2, so it's come down. These companies are able, if they choose, to stop investing in a new terminal, a new transmission line to generate very significant cash flow and therefore deleverage. But at 2 times, I think the interest rate risk is not high for our portfolio. Limited FX, as we've noted before, most of these investments have lined up, if you want, their cash flows in terms of currencies with borrowings, and therefore FX risk is a muted impact. Energy prices, there's been a lot of volatility. It's been pleasing to see most companies pass on. Either they have contracts which allow them to, and or they've been able to pass on and insulate themselves from the volatility in energy prices. Geopolitical tensions I've touched on. I think this is probably the issue for 2024. As I said, I think interest rates will roll over. I think investing conditions will be stronger. But this will definitely be an area that we will need to focus in on and look for opportunities. Next slide, Jax. On this one, on valuations, I'll hand over to Jax.
Yep. The purpose of this, as Charles said, obviously we've got a number of factors within the portfolio that makes us attractive at the moment. That means that some of the sort of the pressures that we're seeing are not so much affecting the UEM portfolio. But I think the purpose here of this slide is really to sort of hammer home at the moment, I suppose, how cheap, or how cheap emerging markets continue to be on a sort of in sort of absolute and relative terms towards sort of the developed markets. If you look at the charts on the bottom left-hand corner, the emerging markets, you can see that over the sort of the last 10 years, emerging markets have traded at an average of around 13.1 times. However, at the moment, they're trading lower than that at 11.1 times, again, showing how cheap they are relative to historic levels. And therefore, we can also see when we compare to the right-hand chart, the S&P 500, how cheap they are compared to sort of the developed markets, which if we look at the S&P 500 sort of cyclically adjusted PE ratio, I mean, over the last 10 years, it's been trading at an average of around about 25 times, but at the moment it's slightly higher than that at 26 times, which just shows you how elevated and how sort of expensive, I suppose, developed market is, and I suppose what a great opportunity that emerging markets are at the moment, given the pricing levels where they are. If we then look at UEM's portfolio as well, I mean, we're trading at around about a 12.4 times PE multiple, slightly higher than, I suppose, the MSCI Emerging Markets Index at the moment. But that is, as we'll come on to, is because of our limited exposure to China, which is dragging down the Emerging Markets Index at the moment. But if we overlay that on top of that is where UEM is trading itself as a trust. I mean, a UEM at the moment is currently trading with around a 16.2% discount at the end of October. That has narrowed over the last few weeks. But I mean, as Charles mentioned, we have had sector-leading performance of a 9% compounded return over our since inception. We've got a yield of around 4.1%, and we have very low volatility, which is providing at the moment a really attractive, sort of compelling entry point for existing and also new investors.
Thanks, Jax. And just to emphasize, when we look at the opportunities in the emerging markets, I think urbanization is still taking place. We've all just been in Vietnam, and it's interesting to note that Vietnam's urbanization rate is only running at 40% and is increasing. And therefore, you know, that trend of urbanization, the growth of the middle class, and the demand, therefore, for the assets that we're invested in, is still there. But overlaying it are a set of infrastructure megatrends that we've identified. So energy transition, and I hope you've all heard of these four before, but just to remind you, energy transition, most countries are seeking a higher level of renewable energy, and the emerging markets are no different. And the emerging markets have the same challenges that developed markets do. Wind in Brazil is in the north of Brazil, and it needs to therefore invest in that, but also then build transmission lines back to the south, where most of the population and the industrial base is. I think the other thing to note in energy transition is energy resilience. There is a sort of a clear observation by governments to look at energy security, and so that will also lead to investment and shifting opportunities within this space. Digital infrastructure, the penetration in the emerging markets is lower than the developed markets. We all know that. It's growing compound very strongly. But if I think, you know, through things like AI, to benefit from AI, you need to be in the cloud. To be in the cloud, you need data centers, you need all the infrastructure within the digital space. So I actually see strong growth within this space. Social infrastructure, it's true to note that the emerging markets are still behind the developed markets in terms of their delivery of things like waste. And there are policy changes that have been made, and there are therefore investable opportunities that are emerging. Global trade, and I've noted this before, while global trade is slowing, there is a huge dynamic taking place. First, driven by, if you want, the frictions between China and the US and the China +1 or China +2 strategies that are emerging. And we saw and heard firsthand about, if you want, in Vietnam, of manufacturing being displaced out of China into Vietnam. And all of that presents new, if you want, flows of goods, new investments. So things like ports, logistics, globally we can look at. And this is happening in Vietnam, it's happening in Mexico, it's happening in India. I think the other observation in global trade is there is nearshoring. Obviously, the impact from COVID, I think, shook up a lot of business in terms of their supply chains that become quite extended and quite focused on one market supplying the industry. And I think there's a strong diversification that's been underway. And again, when we were in Mexico in March, it was evident, if you went to a city like Monterrey, how much nearshoring was being invested into. And those, or these four trends, we believe will continue for the next 10 years. So there's a strong overlay of, if you want, urbanization, middle class. There's a strong overlay of infra megatrends, and this should present us with good long-term investable assets. Jax could talk to you about our portfolio.
Yeah, so Charles has just run through the mega trends, which are the underlying drivers of the portfolio now. But I think what we just wanted to show you here on this slide before we dive into some of the opportunities which we are seeing is just how unique and diverse our portfolio is relative to the sort of the MSCI Emerging Markets Index. If you look on a sector split, if you compare UEM's portfolio to the MSCI Emerging Markets, the MSCI Emerging Markets has, financials, IT, consumer discretionary at 22.5%, 20.6%, 13.6% respectively within those sectors. Three sectors of which, UEM has no exposure to at all. We are playing those sort of mega trends that Charles has referred to. Sort of, we have electricity, and that's sort of electricity transmission, playing that energy that energy transition megatrends that are identified. And if you look at sort of the electricity, renewables, gas and water and waste investments that we have, which constitute just under 50% of the portfolio, that sort of translates into sort of, utilities are in the MSCI Emerging Markets Index of 2.6%, clearly showing how different we are. And then again, if you look at sort of the geographical split, I mean, as Charles said, we are very much bottom-up benchmark agnostics. We don't have to sort of follow the index at all. We don't follow the index at all. So our exposure to China, for example, currently stands around 12.5%, and that is coming down, which we can go into later. But I mean, China, as a constituent of the MSCI Emerging Markets Index, stands around to just under 30%. Where we have exposure to Brazil at the moment of currently 23.5%. Again, just showing you how different we are to the index itself. What I've quoted this before, and I'll quote it again, but it's what one of our investors once said, and I think it really sums up UEM well. We are an attractive alternative way to gain exposure to the economic growth in emerging markets. Again, the emerging market sort of megatrends that we're seeing via a more resilient, less volatile return profile of infrastructure and utility-related investments. And now we can listen to John. Actually, he will run through one of the investments in our portfolio that is playing one of these mega trends.
Thanks, Jax. So I'd like to talk a little bit about Alupar. Charles talked about energy transition and what we need to do to get towards net zero and what every country needs to do. And that's to invest more in renewables, to invest more in the transmission grid. And you can see in the picture in the bottom left on Brazil, it's an enormous country. And you have hydro dams in the middle of the forest, away from the consumption centers. You have the wind and solar farms elsewhere. So wind is very prominent, for example, up on that northeastern shore. A lot of the demand centers are further south. And Alupar is a company which has been in this space for a long time, investing in transmission infrastructure. And you can see their projects on that map, which are still relatively small on a map, but that's over 7,000 kilometers of network. So a substantial amount of grid infrastructure. This is listed on the Brazilian Stock Exchange at about $1.8 billion market cap. And we first invested it in IPO almost 10 years ago. But over time, we have built up the position. We've become comfortable with it, and it's performed very well. It's a compound growth of just under 10% on the share price for the last 5 years. And if we flick over the slide, why do we like Alupar? Well, firstly, it's got an excellent management team. This is a family-run business, but they are exceptionally good with investors and capital allocation. And so they look after their returns and they look after us as minority shareholders. And you have an auction process in Brazil every year for new transmission infrastructure. And companies bid into that process. And what we've seen is that Alupar is extremely good at bidding at the right price. They're very happy not to win an auction if it's the wrong price, if it doesn't give them the returns. And what's happened is a few years ago, they bid into some projects at some, frankly, amazing returns. They estimated there'd be about 15% real returns on the projects. And that's because at the time, a lot of the construction companies were distressed and they stayed away. And they're usually the ones who overbid for these projects. And what that meant is that they had a big portfolio to invest in, to develop. And over the last 3 years, we've seen that their grid infrastructure has grown by about 50%. So they've deployed capital well. And just as a sort of point of reference, it might take 3, 4, 5 years to build one of these projects. They have executed every project on time or early, 6 months to 12 months early, and under budget, typically 20% under budget. So superb allocation of capital. The second reason why we like this sector is the returns. They're regulated returns. So once you've won the auction, you start operating, you then have a 30-year license operating those assets, and it's fully inflation protected. And those inflation tariffs have always been put through every year without any issues whatsoever. So we've seen very good growth in financials. That bottom left chart gives you an idea that we've seen great returns, EBITDA increasing by about 50% again over the last 3 years. And for point of reference again on valuations, this is on 12 times price earnings, paying about a 6% dividend yield. And there are more auctions coming up, not just in Brazil. They've just won one in Colombia as well. And we expect them to continue to grow, to continue to invest, and at the same time, return cash to shareholders as dividends.
Thanks, John. The second mega trend that we've identified is, as Charles mentioned, is digital infra. Digital infra is becoming increasingly essential in all markets, and it's driving economics change as well as social change. As we've seen, devices are getting faster, they're much more affordable. As Charles mentions, we are looking for the opportunities to invest in the infrastructure that is delivering a digital transformation. And Kinks is one company in which we've identified that sort of fits this mold perfectly. So Kinks is currently in the top 10 of UEM's portfolio. It's listed on the Korean Stock Exchange, has a market cap of about just under sort of $0.3 billion. And Kinks operates Korea's only carrier-neutral interconnection data centers and provides internet data centers, cloud, and also connectivity services. Kinks currently have around 6 data centers around Seoul, 5 of which are leased. And they're able to offer co-location, which means they can offer very strong connectivity between their clients. But also they are very well known for their strong and good infrastructure, which means they're able to win blue chips clients such as Google and AWS. Recently, as you can see in the 2 pictures here, Mark, who just to introduce him, is actually our senior analyst covering the telecom sector. So Mark and I actually went to visit one of these data centers in Korea. And why we like this asset at the moment is because actually what they're looking at is they're looking at building or constructing their own 10 megawatt freehold data center just on the outskirts of Seoul. And this will double their capacity, or roughly double their capacity. So as we can see in the financials here, over the last 5 years, they've managed to double their EBITDA. Well, effectively, they're going to double their EBITDA by the end of 2004. But actually, we're going to see a potential doubling again of the capacity which they've got, which we should, if they can execute and dragging and sort of sign up new clients, which at the moment we are seeing very strong demand for, means that they should again be able to double their EBITDA again going forward. And Kinks itself remains relatively well valued. It's currently trading at about 9.8 times EV/EBITDA, which is very discounted to regional peers and also global peers. So again, this is a very exciting company with a lot of opportunities ahead of it. The third mega trend that we are also seeing is global trade. I mean, global trade is continually changing, as Charles mentioned. It's providing us with numerous opportunities within the transportation and logistics sector. Emerging markets continue to grow domestically, and that is driving, I suppose, emerging markets' growth of GDP. By 2040, we're expecting emerging markets' GDP to exceed that of the developed markets. But as again, Charles mentioned, sort of things like COVID, geopolitical pressures, just driving nearshoring has really changed the way in which the world is interacting at the moment on the global trade front. And one company which we very much like, again, is in the top 10 of the UEM's portfolio is Rumo. Rumo is a Brazilian-listed logistics service operator within the rail sector. It currently has a network of around 5 long-term concessions, and it operates 13,500 kilometers of lines. And it has around just over 1,000 locomotives and operates 33 wagons. And what we're really interested in is, as you can see on the map in the bottom left-hand corner, is the sort of the green operations, the sort of the northern operations they have. And one of the lines in which they operates into a state called Mato Grosso State. This is this state currently produces around 10.9% of world soy production and 3.7% of corn production. And a lot of that which it produces gets exported overseas, primarily to China. And what we're seeing is actually the Mato Grosso state itself is able to actually increase productivity over the next 10 years. How? It's increasing the farming area, but also productivity is improved, agricultural capabilities is improving. So over the next 10 years, we should see incremental growth in that area of about 33 million tons, which most of it primarily will be exported. And Rumo is well placed to capture that because, again, I haven't said yet, but there historically has been oversupply in that area. But now what we're seeing is a shift to undersupply. The Northern Arc which is in the north of Brazil, isn't able to handle that growth in volume coming out. And its nearest competitor can't add volume at the moment due to having financial restrictions. So Rumo is able to tap into that 33 million tons additional growth in grain coming through. And because they're able to tap into it, they're able to dominate pricing. So therefore, they will have the pricing power over the next 10 years to really drive up the price of how much they can export for, which is really exciting. Management also have have short-term take-or-pay contracts, which are for a year, which means they're able to again lock in that price, irregardless of the volume in which they export. And Rumo again is reasonably priced at 9 times EV/EBITDA, which means it's again really attractive for us to invest into.
On the social infrastructure side of things, we want to talk about Sabesp. Sabesp is a water and waste company in the Sao Paulo state. Sao Paulo state is one of the most developed states in the whole country, and has a very large population, and Sabesp alone serves over 28 million people. It has about 370 municipalities covered in its concession area, and that includes the city of Sao Paulo, which is about 45% of its revenues. And even with such a developed state, there are households without water and without sewage waste connections. And that's a real issue because health and public policy is a driving factor for improving people's lives. And if you flick over a slide, you'll see, well, why are we invested in Sabesp? Well, firstly, it has a growing base. It's having to invest quite a lot in the new connections, in giving people better sanitation. It's got an improving regulatory regime. One of the things that's been in debate for the last few years has been, are they providing a good return socially and a good return for investors? And that balance is shifting because they're looking at privatizing company. And if you followed us for a while, you know, we invested in Eletrobras, which went through a privatization process, which was extremely successful for us as investors. And we invested in Sabesp a few years ago with the view that this privatization process was happening. We have the governor of Sao Paulo is a chap called Tarcísio, who's extremely passionate about privatization and has just succeeded in getting a vote through the local Senate for privatization. So we expect that this will now move forward over the coming months and next year should hopefully succeed. And that being the case, it unlocks a lot of value for the company and for investors and for the people as well. For us as investors, we should see improved efficiencies, better cost reductions, and better procurements. We should see better regulation. So in the discussion is around universalization of tariffs. And for the people, they will accelerate the investment into the network. And so they're looking at getting everyone connected to a sewage connection by 2029, which is 4 years earlier than the previous plans. And so spend will be accelerated into the network to get them there. And in terms of valuation, what do we see happening through a privatization process? Well, we have had some of that come through already. You'll see in the previous slide that had the share price chart. It's gone up quite quickly, but we do expect more to come. a privatized company, a well-run privatized company, would typically trade on 1.1 to 1.2 times EV to regulated asset base. And this is trading on about 0.8 times. And if you work that backwards, that's probably about 50% upside just on that privatization move alone, notwithstanding what else they can do with the business in terms of efficiencies and tariffs. In terms of valuations, again, it's inexpensive. It's trading on 11 times PE. It has a 2% dividend yield. The yield is relatively low because there is a lot of investment to put into the network, but that's supporting better returns down the line.
Thank you, John and Jax. I hope that brings to life for all of you, if you want both the opportunities that we see, the drivers that we see, but the excitement we have in these, long duration compounding assets. But just to try and summarize before we go on to Q&A, they are cash generative assets, as we've said, and they're operational. And that means every unit, every passenger, every car, every unit of power drops to the bottom line. There isn't a cost associated with delivering it. They are undervalued. I know I said last time that I think almost since we started with this platform and opportunity, valuations are at decade lows, and that's certainly the case for our portfolio. They're resilient through economic cycles. I always say to people, I think our biggest job is trying to sort out the noise from, if you want, the opportunity. And if you looked at Brazil, Lula brings with him a lot of noise. But when you listen to Sabesp and the journey that they're on as a Brazilian company, you can have real confidence that we can make that investment. As Jax has pointed out, we're very differentiated from the EM index. And I think that offers shareholders a real confidence factor that we can look for the performance that we want and not be dragged by the index into areas that may or may not perform. Top right, long term, we've outperformed the index, and I think that is testimony to our approach bottom up and not looking at the index. We have a covered and growing dividend, which is paid quarterly, a very high active share and consistently low beta, and I think that continues for the next decade. And a specialist investment team. I have every confidence in our ability to unlock and invest with conviction into a portfolio which will deliver over the short, medium, and long term. So thank you. We'll go on to questions and answers.
Perfect. Charles, John, Jacqueline, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. John, Charles, Jacqueline, as you can see there in the Q&A tab, we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. But Jacqueline, perhaps if I may hand over to you just to chair the questions with the guys, and if I could just ask you to read those questions out and give your responses where appropriate to do so, and I'll pick up from you at the end. Thank you.
Brilliant, thanks very much. Yeah, we'll start with the Q&A. So the first question that we've got is, do you view the decoupling of performance since this year between emerging markets and developed markets debt as structural or ephemeral? And what are the implications for assets in your investment universe? Don't know if Charles, if you want to take that one.
I'm quite happy to take it if I understand the question. We are seeing, if you want, interest rates drive up the bond market, if you want, as they now roll over and come down. But I think there will be a tailwind for us. I think equity markets will benefit from lower interest rates. I hope that answers the question.
Okay, I think I've got one on for John now. Sorry, John, here we come. It has been a challenging market to enforce regulatory frameworks, higher rates, inflation, translating into higher tariffs. How satisfied are you with the overall resilience of regulatory frameworks in your portfolio?
Thanks. Yes, the regulatory frameworks are different country by country, and their level of adherence to regulation is also different country by country. And I think that's part of our specialism is understanding those regimes and the nuances within them of who is good, who's not so good, and where they might try to fudge things which might not be so good for investors. And if you take Brazil as an example, and if you go back about 8 years, there was a big disruption in the regulatory system because Dilma, the then president, interfered with regulation. She stuck to the letter of the law, so it was legal, but she influenced regulation. So at the time, it went through a very dark patch. But what we've seen in the following 8 years or so is that it's improved. It's become much more professional, much more technical, and we have seen that costs have been reimbursed, returns have been allocated appropriately. And so we as investors are quite satisfied with that regulatory regime. And we're always vigilant if a politician starts talking about regulation and how they may influence it. So somewhere like Brazil has been very good in the transmission and distribution sectors. A place like Chile has been very good. India as well, a very stable regulatory regime. Typically, you get 15.5% return on equity on investments, and that's been delivered sustainably for decades. So those are the places where we've been very comfortable. Other areas where perhaps it's been more nuanced are like China. And so in the energy sector, you may have seen that they have an allowed return on asset, but no one seems to ever get there because there's little movements in the background. Perhaps my sector, it could be exposed because there's an end consumer seeing a high electricity price, and that is politically sensitive. But I think, Jax, perhaps your sector has been a bit more directly and noticeably hit if you take, the toll roads as an example.
Yeah, I mean, I think, as John said, the regulatory framework really depends country by country and also sector by sector. I mean, yes, if you look at China, for instance, they had long-term, or the toll road operators have long-term concessions. But a couple of years ago now, I mean, overnight, the government announced that public holidays would be toll-free. And this just happens overnight. And you have no insight or, no warning that it is going to happen. And we are still sitting there waiting for the government to tell us what the compensation will be. I mean, we're told that the compensation will be extensions of the concessions, but however, no clarity is given. And often a number of the toll road operators within China, for example, will be given toll road projects or have to extend concessions, but you don't know what the rate to return is going to be until you actually started construction. So as an investor, it makes it really difficult for us to actually buy into those assets. And as John said, I mean, Brazil typically has been very good for me. Concessions are respected. If any there has been changes in the concessions or any changes in some of the clauses or the concessions, they the operators tend to be compensated, which makes it, which as an investor, we can be much more confident investing into those markets. If I move on to the next question, one of the questions that has come in is, do you see the market is fully discounting the value of unlisted assets in the portfolio, and will you look to reduce this allocation going forward? Charles, I'm not sure if you would like to take that one.
Happy to. I think at the moment markets are, if you want, discounting value across the board. I don't think it's just unlisted. If you looked at UEM's discount versus most other investment vehicles, we're all at the high side of where we would want to be. And back at lows in 2008, and all that's telling me is shareholders are seeking out, if you want, liquidity. So I don't see a differential between the valuation approach. But to try and answer the question on unlisted, we realized one in the last 6 months, and we're in the process of realizing a second. And I think we're unlikely to make further unlisted investments. So the direction of travel is fewer and smaller. Obviously, some of the unlisteds may well perform as investments themselves and therefore grow as a percentage. But I think as individual investments, I think we won't be making further investments into the unlisted space.
Okay, thank you, Charles. Going back to you, John, how important are wholesale energy costs to making the investment case for the underlying protection of your holdings? And is there any notable trends in this regard?
It depends very much on the jurisdiction again, and also what you're looking at investing into. So if we're investing in a transmission company, the wholesale costs makes very little difference on the project returns. If you're looking at a generation asset, of course, this does play into it quite strongly. But this also depends on the structure of the market. So as an example, a lot of the renewable assets in Brazil, they're also bid out on auctions, and they're given fixed PPAs, so fixed pricings with inflation adjustments over a certain duration, typically 15 years. And so for them, the wholesale price matters only if they can't deliver energy which they've promised, so they don't have exposure, or if they decide not to sell into that kind of market and they decide to sell into the free market, which means that they're taking the risk on that wholesale price. So different companies have different strategies, and at certain points in a cycle, some will do extremely well and others less so, and vice versa. So it depends on weather, it depends on pricing conditions. It depends if El Nino's present at the moment, and so we get different climatic rainfall patterns, etc., across Latin America, and so it does matter. And I think the one I'd sort of highlight is ENGIE Chile, ECL, which has a lot of generation assets in the north of Chile, and they were very exposed through 2022 because they had to buy a lot of energy at very high prices. And if you looked at their financials, and I think we talked about it in the annual report, their financials got hit very hard. And so those kind of generation assets can have exposure. But if you took a picture broadly across the portfolio, we have very little exposure really to those dynamics.
Okay, thanks, John. Charles, another question for you. Who are the typical marginal buyers and sellers of stocks in your portfolio, and how do you see structural flows developing over the coming years in this regard?
So, good question. I think if I look across the emerging markets, if you look at Vietnam, if you look at Brazil, there are, if you want, three groups of buyers. One is the retail market, the local retail market. And certainly the local retail market has withdrawn over the last 12 months, and understandably so. They can achieve good returns in bonds and fixed income. So I think, exactly like the UK, you're seeing the retail investor has stepped away from the market and is a seller. The local institutions continue to be buyers, but they're probably quite selective. The international institutions have definitely over the last year stepped away. They can see the interest rate environment. They can see the returns, quite frankly, that have been on offer in the US. But if I look forward to, say, the next 12 months, I think all of that's about to change. As interest rates come down, I think the retail investor will start to reinvest in the local market. And I think international investors, as interest rates go down in the US, the dollar weakens, will look for returns in the emerging markets. So perversely, what's held back valuations at the moment, I think may become a tailwind over the next 12, 24 months.
Okay. Thanks, Charles. One question is, how does the trust manage country-specific risks, especially in emerging markets with political volatility?
So I'll try and answer that. While we're bottom-up investors, we do spend time top-down trying to understand, if you want, individual country risks, and it usually comes down to, if you want, political and legal infrastructure. So if you looked at somewhere like Russia, we've only ever had one investment in Russia from time to time, and that almost taught us why we shouldn't be investors in Russia. It was just too difficult to have certainty about outlook. So there are countries which we find too difficult. Argentina has been one. It'll be interesting to see with the incoming president how Argentina actually shifts. But for us, it's just too difficult on a top-down approach. So there is an element of top-down overlay, but having settled that, as you've heard, we will look for opportunities across the emerging markets. And as long as we can get comfortable with the quality of the asset, the quality of the management team, and the quality, if you want, of the political and the legal and the regulatory framework, we can then make investments with confidence.
Yeah. Thanks, Charles. Another question that's coming is, I think it's important for managers to have skin in the game. How much stock do each of you own in UEM?
So I directly own over 400,000 shares in UEM. I agree with the approach. I think we should be aligned. I think one thing before Jackson John answer the question, all our board take their fees in shares and have done since inception. So they are reasonably invested in UEM and if you want, focused on the fund's performance.
And on my side, I haven't disclosed figures, but it is my largest investment outside of my house.
And I also do have exposure within my investment portfolio. Yes. Another question. Not sure if you can hear me. I'm not sure if I've frozen, but there was a question about Venezuela just come in. John, I don't know if you, John or Charles, I don't know if you want to. I can't read at the moment. Unfortunately, my computer's frozen. But
it's just the comments on Venezuela's threats to Guyana. I mean, any uncertainty in a local geography is unhelpful. It's additional noise. It's additional concern. I note that Venezuela has been very disruptive to the immediately local region for quite a while. There was a huge displacement of population into Colombia over the last few years. And the noise on Guyana, you have to question quite what would happen or might happen, given the biggest interest there is Exxon, US-backed oil company, because of the offshore oil. And so whether this is noise and a distraction because of the upcoming elections in Venezuela, or whether it turns into something more serious, we will have to wait and see. But any disruption is obviously unhelpful, though immediate implications for UEM are extremely limited.
Okay, thanks, John. The final question is, how efficient is price discovery in the different markets for your holdings, where there are substantial upfront outlays for capacity builds, etc.? If I understand the question correctly, I think what you're asking there, Callum, is, you know, if you've got a substantial capex up front, how much is that recognised in the valuation of the company going forward? I mean, that varies very much also how clear and coherent the company are at informing investors of what they are, I suppose, what they're investing in, and what the value of that will be going forward. So it can really vary from company to company. For example, Kinks, as I said, they're looking to double the capacity of their data centers, which is going to come on hopefully online in mid 2024, and which they're hoping to have the whole data center full by within 1 to 2 years. I don't think yet the market has really fully taken that into consideration, partly because the company is also trying to sort of, I don't know, sort of set expectations too high within the market. I mean, Mark and myself were in Korea literally a few weeks ago talking to management and understanding the opportunity, which means that we can really get a good insight knowledge into what is going on. So it really does vary from company to company. I think, John, within your sectors, I mean, sometimes the capital outlay is probably more clearly set out because it's in the concession contracts. I don't know if you want to...
Typically, they would be in the concession contracts, although as is talked about with Alipar, they can come in under budget, and then they keep that kind of efficiency gain. But really, it's understanding who are the good capital allocators and who tend to go over budget and who might come in under.
Yeah, again, it really varies. But I suppose that's our job, is identifying the opportunities and making sure that they can add the value, and then we can hopefully invest in those companies where the value then is where the value then comes out in the future.
Charles, John, Jacqueline, if I may just jump back in there, and thank you very much indeed for addressing every single question that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you guys to review, to then add any additional responses, of course, where it's appropriate to do so, and we'll publish all those responses on the platform. But Charles, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Thank you. I think to wrap up, UEM, I think, has a unique position and a unique insight into the development of the emerging markets. And because of all the trends and the tailwinds, now is a fantastic time to be an investor in this space. We are super excited, but we believe our portfolio is undervalued in itself. We believe that if you want, the yield is sustainable, and we believe that the discount ought to narrow as markets turn back to investing in equities. So we'd be very pleased if investors went on the front foot with us. I'd note we buy back shares daily. I think that's just a statement of conviction, but we are optimistic about the coming 12 months. I'd also just like to wish you all the best festive period, and I hope it brings you everything that you're looking for. Thank you.
Perfect, Charles, that's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the UTILICO Emerging Markets Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.